The monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people who are demanding silver suddenly as money because they're panicking.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025 while supplies last. First this week, 1 ounce Gold Philharmonics are just $99 over spot. Next, 2 ounce Silver Canadian Rocky Mountain coins are only $4.50 over spot per ounce. Finally, Kilo Silver Britannia coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for joining us today.
Hey Elijah, good to be back.
Well, it's great to have you today. I did want to discuss the pullback we've seen in precious metals on Friday and Tuesday. Huge drops, but at the same time, it's kind of funny because we're just where we were earlier in the month, but everyone's freaking out. So your take on where we are at the moment?
I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It just, nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started, it kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged because we're still in a dollar short squeeze where there's more debt than dollars that exists, and that's what's going to happen.
Now, what I found really interesting is on one of your recent posts, we'll put it in the link, we'll put the link in the description of this video, to a chart you shared, the gold-silver ratio. And it wasn't even the gold-silver ratio that you shared, but you shared the silver chart overlaid on the gold chart, and it showed that when we do have blow-off tops in the silver market in 1980 and 2011, and you can even through in 2008 that peak as well, we see a huge divergence between gold and silver. Silver outperforms dramatically, and that's not what we saw. We saw a little bit of outperformance on that last leg by silver, but really gold and silver moved together for the most part. So that signals that we aren't at a blow-off top stage. Can you share a little bit about this, the gold-silver ratio, and what that signals to where we are in the bull market?
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918, since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like obviously, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best? And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate, and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
You mentioned how really the fundamentals as well have not changed with respect to this pullback here. One of the things that is concerning recently, and we've talked about this quite a bit on the show with you, is the reverse repo market. What is the latest there, and why is it potentially signaling concern for the near future?
So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started, at the peak of the balance sheet was sometime in 2021 for this. So for the last 4 years, maybe 2022, I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT is it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio, the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, and in 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less, because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like $60 or $70 billion more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion. So it's like 2.91 trillion or something. And the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow it could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves have run out. It's being used and sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding, as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just, they're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. And it's going to end soon because the repo rate is already moving several basis points a night. It's already tight.
You know, it seems like, I mean, in the silver market, we saw where the futures market was way lower than the spot price. And it seems like across the board, there's strange, strange action in the markets. As we've mentioned at the beginning, these huge down days in gold and silver as well. Now there seems to be talk as well about tightness in the platinum market and even tinier market than either the gold or silver markets. Your take on platinum right now, as we've seen it, increase about 50% or more this year alone. Your take on where we could go if tightness gets really dramatic there.
Okay, well, since monetary analysis is my bent, and that's how I see the world, if you read these books on hyperinflations, isolated hyperinflations in the world. I remember reading once, maybe it was When Money Dies. I forgot who the author was, but it was about Weimar. And he was talking about during the late 1923, when the hyperinflation was in full swing, you had government agents of the Weimar Republic just like raiding people and stealing whatever hard money they had on them to try to get ahead of the hyperinflation, where they had gold coins in their pockets or silver coins. And they even outlawed platinum, because some people were hoarding platinum and using platinum for exchange because they couldn't use the stupid paper mark that like. So even back in 1923, platinum was still being hoarded as some kind of a money, as some better money than paper money. So the reason platinum would be disjointed, not necessarily because there's a sudden demand for catalytic converters or whatever, platinum is used for primarily, and that's primarily catalytic converters in cars and other strange niche kind of things that I really have no understanding of. I don't understand car parts or anything like that. But since it is a pseudo money and the liquidity is so low, people could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. And they might get some silver, but they might also want something that's more value dense just to preserve their wealth. And they don't want gold, and they think the platinum is really cheap because, they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value, and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it. And that could overwhelm the very, very thin platinum market, as it's overwhelming the silver market, which is why you're seeing all this disjointing through London and New York. What that means, just very broadly, in a broad brush strokes, is that the monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people that are demanding silver suddenly as money because they're panicking.
So moving forward here, I mean, you mentioned the dislocation we're seeing in London and New York. It has narrowed quite a bit to under $1 spread there. What does this signal? Because you've also mentioned how this isn't really technically backwardation, which a lot of people are calling it. What does this signal going forward in the silver market?
I think it's just a peculiar thing going on with London, because the ETFs happen to be stored, their metals happens to be mostly stored in London. I think SLV has a little bit in New York, but the amount of silver in being stored for SLV in New York hasn't changed in many years. It's the same in the same JPM vault. What changes is the vaults in London. So it's just signaling that London, which is the main physical spot market for the world, is short on silver. Not that they're selling it short. I was saying they don't have enough supply, and you can see that in the float, because they have to store for the ETFs. And though ETF storage is not anywhere near where it was in 2011, it's slowly building back to that as investment demand is growing. So silver squeeze was an interesting movement back in February 2021. Now is when it could really succeed, because if people bought a bunch of silver ETFs, then they could really blow that spread out, because then London would really need the silver to be shipped there immediately. It's just so it could keep the ETFs in line with price. Because what would happen to these ETFs this is my theory, that if SLV, for example, couldn't store or couldn't buy silver because there wasn't enough in London, then how would it be tethered to the silver futures price? It couldn't be tethered, and then you'd have the SLV, because it was lacking shares, just spiraling higher and higher and higher, and then that would create a feedback loop where it would force London to import silver from anywhere it could at any price just to keep SLV under control, and then you'd have this positive feedback loop that I don't know how they would get it back in control. That's what Silver Screws was trying to achieve, and I think it could achieve that now, specifically because of the spread between London and New York. But why I say it's not backwardation is because New York silver is a different good from spot London silver. According to Mises in his book Theory of Money and Credit, he differentiates between goods in different places or technically different goods. They're similar goods, but they're different because let's say a bushel of wheat in a starving African country is not the same good as your marginal bushel of wheat, in some warehouse in Nebraska or wherever grows wheat is. It's worth very little there, but it's worth a lot in Africa or whatever country might be starving there. So what backwardation would be is New York spot silver, meaning October silver would be this month, would be more expensive than, let's say, December future silver. That we're not seeing yet, but we will see that. And when we see it, we'll know that silver is really in backwardation, and then things could get pretty spirally.
And I think that then ties into the thesis that there just really isn't enough silver out there. A lot of people have been pushing back against that idea, but is that your view that in the future, as we move into this monetary debasement and end of the dollar and end game for the financial system and reset, that there just won't be enough silver to go around?
Well, no, there's always enough silver. There's no such thing as a silver shortage because there's no such thing as a gold shortage. The only question is, what do you have to offer to get people to give it to you? How much are they going to go for? Right? We've seen the staggering amounts of silver in New York vaults. It's still above 500 million ounces, which until 4 or 5 weeks ago or whatever it was an all-time record. There is silver. There's a lot of it. Even London has a lot of silver. It's just most of it is being stored in ETFs, and in New York, most of it's being stored by who knows who owns this stuff. It's there. It exists. It's just people aren't selling it for the $50 that the exchanges say that it's worth now. So what does the price have to go up to in order for this silver to be dispersed, to the masses or to whoever wants it? Prices are going to have to go up. Yeah. In the meantime, you have these market actors that can mess with the price. I'm not saying in a nefarious way. It's just I don't know exactly what is causing silver to sell off a few days ago specifically then, but there is a lot of silver. It can get loose. The question is, how many dollars do you have to pay for it in order for that to happen?
Have you thought at all about the type of silver to invest in? Because I know some people really like the junk silver, right? For example, we're hearing some slightly concerning developments from refiners that they're all backed up at the moment. I mean, not all of them, but some refiners are being backed up. On the wholesale side, what I'm hearing is it's really not like a huge issue. But do you see any concern with respect to pure silver versus the old U.S. coinage, or do you think at the end game, it really won't matter a whole lot? It's just that, that you have something of true value.
It won't matter that much. I don't think. You just don't want to get scammed. You don't want to buy something fake. So just go with a retailer you trust who won't cheat you. And there are plenty of those. Miles Franklin is one. I'm not worried at all about them. Certain coin shops that I know, I'm not worried at all about them. But if you have a perspective if your perspective is which physical silver should I buy so that I can have more dollars 6 months from now than I had before when I sell it back for dollars, that's not where I'm coming from at all. I'm not going to sell. I don't intend to sell any of my silver for dollars. I intend to sell my silver for stuff. In other words, I intend to buy things with the silver because I don't think the dollar is going to work. And so then the question from my perspective is which coins will be taken the most easily in a market where people are actually handing coins to each other, because credit is dead. So I'd say probably government coins would be more liquid. Just because they're more recognizable. Whereas if you have a silver ounce that's a round from some mint that has a nice, a very pretty picture of something that nobody's ever seen before, it'd probably work. It'd probably be okay because they'd test it and they'd figure it out that it's real and they would sell to you. But I think it would just be easier if you want to get in, out, shake, shock without, people having to, bring their scales or bring their electromagnetic whatever sensors to check that it's real. If you don't want to deal with that, just get junk silver, quarters, dimes, and nickels that people recognize, or whatever country you're in, some legal tender that is in your country that people would recognize. It would just be easier, but I don't think the difference is that great.
Well, Rafi, really appreciate your time today as always. If our viewers are interested in learning more, they can go to endgameinvestor.substack.com. We'll put a link in the description of this video to that. I guess for our viewers, any last thoughts you had, given that it seems like kind of turbulent times in the markets, but what is, I guess, maybe some insights that you would give to kind of, I guess, help people to step back and see the big picture?
Yeah, don't go down the rabbit hole of manipulation. The banks are in charge and they'll be in charge forever, and there's nothing we can do, and they're going to smash silver down. It's going to be the same. And I think don't get caught in these loops that are unprovable. That there's nothing you can do about them. Like, how are you going to stand up if you think JP Morgan is all powerful? Okay, fine. You think JP Morgan is all powerful. What are you going to do about it? Just when your brain goes into these dark places, just like, look where we are now. 4,000 is a support zone. Just calm down and know that these sell-ups are going to happen until the final printing round kicks in. So just take it in stride, relax, and don't get being too negative. Being too positive is just as dangerous as being too negative. Like when gold was first hitting 4,400, and we're like, oh wow, it's going up $100 a day. It's going to go up to 5,000 tomorrow. Maybe it could have, but it didn't. But we also have to be ready for that. So be ready for serious ups and downs that are going to make you nauseous if you follow them too closely, and just know where the end game is. The end game is where the dollar gold silver exchange rate doesn't matter at all, because no one's going to want any dollars. It's just going to be how much do things cost in gold and silver, and that day is coming, and it's coming soon, and let's just wait for it.
Fantastic. Well, Rafi, once again, we really appreciate your time and insights today. Thank you so much, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025, while supplies last. First this week, 1-ounce Gold Philharmonics are just $99 over spot. Next, 2-ounce Silver Canadian Rocky Mountain coins are only $4.50 over spot per ounce. Finally, Kilo Silver Britannia coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.